All right, let's talk about one of the most important and honestly most misunderstood numbers in your entire financial life, your credit score.
You've definitely seen it. This three-digit number that seems to control so much, from getting a car loan to renting an apartment, even the rate you pay for insurance. But what is it actually? How's it calculated? And who's even in charge here? Well, we're going to break it all down.
Okay, the absolute best way to get this is to think back to school. Your credit report, that's like your official school transcript. It's a super detailed list of every class, or in this case, every credit account you've ever had and how you did. Your credit score, then, is basically your financial GPA. It's that one single number that sums up your entire performance. So, who's writing this financial transcript of yours? A lot of people think it's the government, but that's not it at all. It's actually a handful of private companies we call credit bureaus. Just think of them as giant data collectors, constantly gathering information about you from banks, credit card companies, and even public records. Here in the US, there are three main players in this game: Equifax, Experian, and TransUnion. These are the big three. And what's wild is that each one keeps its own separate report on you. That's actually why your score might be a little bit different depending on which one you look at. They're all working from slightly different notes on your financial history.
So let's get right to the point. Why does this score even exist? From a lender's perspective, it has one job and one job only: to predict risk. It's a formula that tries to answer the question, how likely is this person to pay back their loan over the next 2 years? That's it. A higher score just means you look like a safer bet.
So how is that financial GPA calculated? It's not some top-secret recipe hidden in a vault. Most credit scoring models, like the ones from FICO and VantageScore, are built on these 5 key ingredients, each with a different level of importance. Let's take a look. First up, and this is the absolute heavyweight, making up a huge 35% of your score, your payment history. It really all boils down to one simple question: do you pay your bills on time? Seriously, even one payment that's more than 30 days late can knock your score down. Consistency is king here.
Right behind that, at 30%, is amounts owed. Now, this one's a little tricky. It's not just about having debt. It's about how much debt you're carrying compared to the total amount of credit you have available. This brings up a really crucial idea called credit utilization, and trust me, we're going to circle back to that in a minute.
Next, weighing in at 15% is the length of your credit history. Lenders love to see a long, well-established track record. It just screams stability. So this factor looks at things like how old your oldest account is and what the average age of all your accounts is. In this case, time is definitely on your side.
Then we've got credit mix, which accounts for 10% of your score. Basically, the scoring models give you a little boost for showing you can successfully handle different kinds of credit. Having a mix of things like credit cards, which are revolving credit, and something like a car loan or a mortgage, which are installment loans, it just proves you're a responsible borrower. And finally, the last 10% is new credit. If you suddenly apply for a whole bunch of new credit in a short amount of time, it can look like a red flag. To a lender, it might seem like you're in some kind of financial trouble. Every time you formally apply for credit, it creates what's called a hard inquiry, and that can cause a temporary dip in your score. Okay, let's zoom back in on that amounts owed piece, because this idea of credit utilization is just so important. It's simply the percentage of your available credit card limit that you're using. So, if you have a total credit limit of $10,000 across all your cards, and you currently owe $3,000, your utilization is 30%. Simple as that. And if you want to see just how big of a deal this is, just look at this data. It's incredible. People with the best of the best credit scores, we're talking 800 and up, they keep their average utilization way down, around just 7%. Now, compare that to people with poor scores. They're using over 80% of their available credit. The link between low balances and a high score is just undeniable. Okay, so this brings up a really common question. Let's say you finally paid off that old credit card you never use anymore. So, should you close it? It feels like the right move, the responsible thing to do. But you might want to think twice.
Yeah, it sounds crazy, but closing that old card can actually hurt your score for a couple of big reasons. First, you instantly lose that card's credit limit from your total. That can make your utilization ratio shoot right up. And second, when that account eventually drops off your report, it can drag down the average age of your credit history. So unless the card has a huge annual fee, it's usually better to just leave it open.
So how do you actually look at your own financial transcript? Well, by law, you are entitled to a totally free copy of your report from all 3 bureaus every single year. But listen up, this part's important. The only official government-mandated website for this is annualcreditreport.com. Watch out for other sites that look similar. They'll probably try to sell you something you can get for free.
And please, do not worry about checking your own credit. It will not hurt your score. That's called a soft inquiry, and lenders can't even see it. A hard inquiry only happens when you actually apply for new credit, and that's the one that can have a small, temporary effect on your score.
And just a quick word of warning here, if you ever see a company promising a quick fix or a way to erase bad credit overnight, run the other way. As the Federal Trade Commission says, there are no shortcuts. Building good credit just takes time and good habits. No one can legally remove accurate negative information from your report.
So, after all that, what are the big takeaways? It honestly boils down to 3 simple things. Number 1, pay your bills on time, every single time. That's the biggest one. Number 2, keep your credit card balances low. That 30% utilization number is a good rule of thumb. And 3, check your free credit reports for any errors that might be holding you back.
And that's really how credit scores work. See? It's not magic. It's just a number reflecting your financial habits over time. For more explainers just like this one, make sure you're subscribed to the channel. Thanks for watching.